Hello, everyone, and welcome back to the G22 Report. I am your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you haven't. Just a little disclaimer, nothing should be construed as financial investment advice. My opinions, thoughts on the markets. And let's get into today's stuff. Really big day, down day, that is, for gold and silver. One thing I want to get in point, this isn't talked about enough. And one of the reasons I think they're correcting is the Chicago Mercantile Exchange has recently raised margin requirements for gold futures to manage risk. Specifically, increases have been around 5.5 to 5.9% for gold, 8.5 to 9.4 for silver, which is a significant hike in pressure they need. So that's why I think you're seeing days like this. People, they have to liquidate when they are raising margin requirements. Let's see, where is when you have margin requirements, you borrowed at a lower rate, you're gonna have to sell. So 130.80. So and I mean, let's take a look. How many times has the CME raised the margins on gold? Let's see, last time. So here it is. Margins were increased 2011, 2022. And I remember, let's see, what was gold price? What was the gold price in February? Beginning. I wish I had that. Fluctuate of a low 179 and a high of 1974. So, as you can see, they raised margin prices, but 2022, a lot of that was the war, and you can tell that spike didn't last long because of it. And here in 2011, margins were increased multiple times. So history repeats itself. So this looks like it will probably be a 6 month correction, maybe a year or two. I'm thinking 6 months, but it could be even more. I hope it's not more, personally, but anyway, you actually look at this. Margin requirements, these are a killer. And I think this is the main thing. So I wish there was actually more coverage on this on gold channels instead of the obnoxious content they do. The dollar's dying. Oh, the US debt. Oh, the Fed's going to print money. Yeah. People should talk more about this because as you can see, it has a lot more impact. So anyway, let's go into the actual economy while the stock market's going up. Americans in crisis mode as so basically what this article is about, just showing you that challenge financial health is so bad that it's pushing them to seek legal advice at near historic highs, according to Legal Shield. It says bankruptcy inquiries surged 17% in the third quarter of this year, continuing an upward trend that began late in 2021. This pushed consumer stress legal index up 4.4% and seven consecutive months of increases, reaching its highest level since March of 2020. Well, what happened in March of 2020? I think you know. So we're seeing families hit crisis mode heading into the holidays, especially around unsecured debt and rising house costs. So anyway, there you go. So consumer stress, they now need legal help. So what else is going on in the US economy? Paying too much for health insurance, get ready to pay more. Health insurance premiums are rising, on track to rise in a big way in 2026. So there you go, 2026. Higher health insurance costs. There you go. Meanwhile, the stock market just humming along. What will affect this market? So it's unbelievable how this market just keeps going and going. So right now, I think they're just excited about the low interest rates. Oh yeah, the Trump trade deal with China, and so basically, it's going to be like trading with China during Biden, but he's just going to rebrand it. That's why it's Taco Trump. You know, that's the thing. You want to bring back manufacturing to America, you have to crash asset prices. You have to crash home prices, and you have to crash the stock market. Those are all laws of finance. And you have to do it. You have to unfinancialize this economy. Homes, everything. Homes, financialized, whether you like it or not. So is stock market. So yeah, you have to do it. He's not going to. He's a taco, I guess. An ever-growing share of Americans are underwater on their car loans. So yeah, this is what I was trying to delete this, but here it is. Yahoo Finance is finally auto loan delinquencies are soaring with consumers hit by high car prices, up more than 50% since 2010. So I was talking about that. Right now it's the subprime, but it's not so it's right now it's mainly the subprime, but it's going to keep going and going. Uh, Look at this. More and more people are struggling to make ends meet. So there is nothing. There was something. Thought it said something. Yeah, the subprime auto lender, Tricolor and auto parts with First Brands. And look at this, JP Diamond. When you see one cockroach, there's probably more. And I agree, there is. But right now, it's so hyper focused on trade and the Fed cutting rates. This has taken a back seat, so I don't need that. And here's the other thing. I just thought this was ridiculous. And I wanted to do it more, but big tech's AI ambitions are making us power grid and consumers are paying the price. And basically, the consumer is basically subsidizing all the AI data centers. And it's not even like a tax or a fee or whatever. It's literally they're just passing that electricity bill, and that's why electricity bills are up so much. And what do? They fire people. They fire people. That's what they do. No thank you. No anything else. No jobs for people. We're gonna hire a lot of locals. Just oh yeah, we're gonna take your damn money, and then we're gonna make sure you're fired. Well, it's utility companies and their customers are stuck footing the bill. Could be. That means when they say could be, that means it really is. So, should demand ultimately fall short, utilities can be stuck with stranded assets generating no revenue. So, as I said, data centers to nowhere. Data centers to nowhere. This is Tech 2.0. So the question is when it will burst, not if. So, and I thought this was so and then here's the other thing. This is why I was just sort of if you look at my last videos, I was saying trim, trim, trim. That's what I'm doing. I think right before there was a down day and then an up day. And I think right before that last really big up day, right on that last very big up day, I unloaded the rest of the physical I wanted to sell. I didn't sell it all. But anyway, Goldman Sachs says demand for gold is not just hype and predicts US could still see the repeat of Nixon era spike. Goldman Sachs rallying remains in fundamentals, not frenzy. So there it is. Goldman Sachs predicts that gold will reach 4,900 by the end of 2026. So Goldman Sachs, they are loving in gold. So anyway, that's all. Don't believe the hype. Uh, Gold is going up. I mean, Goldman Sachs, Wall Street loves gold. They don't hate gold. I think gold, it's going to be, it'll probably start going up. Worst case scenario, late 2026. But this looks like the first real correction of that breakout since 2000. April was somewhat, but then it went up. But we'll see what happens. Anyway, hit that like button, subscribe, and just remember nothing in this video should be construed as financial investment advice. I just had to do a video because I'm super tired. Not because I'm super tired, I've had a long, exhausting couple of weeks or weeks since I had one, and I just had to get one out. I'll try to get one out again. Remember, regular guy, work jobs, raising kids, raising family, keeping house together, so I don't have time to do videos all the time. If I could do this as my job, I could be a lot better. I'd actually sound a little bit less beat. But anyway, hit that like button, subscribe. I'll see you next video.